Let's cover the sale of inventories from one company to another company in the same group. The consolidation journal entry for sale of inventories between companies of the same group involve eliminating trade payables and receivables arising from the sale if the buyer has not paid the seller. The whole sales transaction should also be eliminated. Companies will usually sell its inventories above cost. If it is a transaction between companies of the same group, the sales will inflate the cost of inventories, which we need to revert it back to the original cost purchased by the seller in the group financial statement. Let's see how this works. The holding company sold goods costing $100,000 to the subsidiary company at 50% markup, meaning at $150,000, obtained by taking 150% multiplied by $100,000. The subsidiary company have not paid the holding company yet, and the subsidiary have sold the inventories to external parties. Let's consider the journal entries the respective companies will enter. When the holding company sold the inventory to the subsidiary company, it debits accounts receivable, credit sale by $150,000 to record the sale. Also, it will debit cost of sales, credit inventory by $100,000 to record the cost of goods sold. On the subsidiary side, when it purchased the inventory from the holding company, it debit inventory, credit accounts payable by $150,000. These are the transactions that occur within companies of the same group. The next entry the subsidiary will enter is debit cost of sales and credit inventory by $150,000 to record the sale of inventory to external parties. Now, don't worry about the price in which the subsidiary sold the goods at. For the purpose of consolidation, the selling price to external party is not relevant, so we will only look at the journal entry to record the cost of goods sold. This entry is not an internal transaction between companies of the same group. It is a transaction with an external party, so it will not be eliminated upon consolidation. Let's compute the net effect of these journal entries. Next, let's identify only the journal entries of transactions with external parties. I told you earlier on, it is debit cost of sales, credit inventory to record the subsidiary selling the inventories to external party. But what is the amount involved? Is it $150,000? No, we must recognize the cost of sales at the original cost the holding company purchased the inventory at, which is $100,000. Treat this as if the sales between the holding and subsidiary company did not happen at all, since it is a sale between two companies of the same group. Now let's enter the consolidation journal entries to eliminate all entries that does not involve a transaction with external parties. First, we debit accounts payable and credit accounts receivable by $150,000 to eliminate the payable and receivable balance arising from the sale. This is pretty straightforward. Next, we debit sales and credit cost of sales by $150,000 to eliminate the whole sales transaction. Earlier on, I mentioned that we may also need to revert the inventory balances to original cost. This is not applicable here because the inventories have been sold to external parties, so there is no inventory where the balance needs to be reverted. It applies only to a case where the inventory has not been sold to external parties. Anyway, in this example, let me illustrate how it works. We will assume that the holding company sold inventories costing $200,000 to subsidiary company at 50% markup, which is $300,000. 150% times $200,000. The subsidiary company have not paid the holding company the amount owing yet, and this time round, the inventories have not been sold to external parties within the year. It is still with the subsidiary company. Let's consider the journal entries each company will enter. To record the sales, the holding company will debit accounts receivable and credit sales by $300,000. It will also debit cost of sales and credit inventory by $200,000. The subsidiary company, on the other hand, will debit inventory and credit accounts payable by $300,000 to record the purchase. This is the net effect of the journal entries entered by both the holding and subsidiary company. Since these journal entries are solely transactions between companies of the same group, we want to undo them completely. The consolidation journal entry to eliminate the payable and receivable balance arising from the sale is debit accounts payable and credit accounts receivable by $300,000. To eliminate the whole sales transaction, we will debit sales and credit cost of sales by $300,000. By now, you should notice that we have not fully undone the effect of the sale as shown on the right. The third consolidation journal entry involves reverting the inventory balance. The subsidiary will record the inventory at the cost it purchased, which is $300,000. For the group financial statement, we must record the inventory at the original cost, which is the cost at which the holding company purchased the inventory at, $200,000. So you will notice that due to the sale, the cost of inventory has increased by $100,000. We cannot inflate the cost of inventory just because the holding company sold the inventory to its subsidiary, so we have to revert it back to the original cost. We know we need to credit inventory by $100,000 to revert it back to the original cost, but what do we debit? Refer to the net effect of journal entries entered by both companies as shown on the left and compare it with our current consolidation journal entry. Which entry on the left has not been fully undone? It is the cost of sales entry, so we should debit cost of sales by $100,000, and you will see that these three consolidation journal entries completely undo the net effect of entries entered by both companies. Now you notice that these consolidation journal entries have caused a net decrease in profits by $100,000, but no worries because this is a downstream transaction, holding company selling to subsidiary company. The profits of the holding company goes to itself. But if it is an upstream transaction where the subsidiary company sells something to the holding company, the profit goes mostly to the holding company, while a small portion is attributable to non-controlling interest. This requires adjustment to the non-controlling interest if the consolidation journal entry causes a change in the subsidiary's profit. So in this example, we will assume that the holding company owns 75% of shares in the subsidiary company. The subsidiary company sold inventories costing $50,000 to the holding company at 40% markup, which is $70,000 if you take 140% multiplied by $50,000. The holding company have not paid the subsidiary the amount owing, and the inventories have not been sold to external parties yet. It is still in the holding company. First, we will eliminate the payable and receivable balance arising from the sale. Debit account payable, credit account receivable by $70,000. Next, we will eliminate the whole sales transaction. Debit sales, credit cost of sales by $70,000. Given that the holding company have not sold the inventories to external parties, it means the holding company is carrying inventories at inflated cost. The holding company would record it at $70,000, and the subsidiary company originally purchased the inventory at $50,000. So we need to revert the cost of inventory back to the original cost of $50,000. We debit cost of sales and credit inventory by $20,000. This is an upstream transaction where the subsidiary company sold something to the holding company. So the subsidiary company will record the profit from selling the inventory, which we would have eliminated through the third journal entry to revert the cost of inventory back to the original cost. This will affect the share of profit attributable to the non-controlling interest. Let's first compute the net effect on profit of this consolidation journal entry. These three journal entries will affect the subsidiary's net profit, and it caused a net decrease in profit of $20,000. Given that the holding company owns 75% of shares in the subsidiary company, this means the remaining 25% is attributable to the non-controlling interest. The decrease in profits attributable to non-controlling interest is therefore 25% multiplied by $20,000, giving us $5,000. The journal entry to record a decrease in share of profit attributable to non-controlling interest is debit non-controlling interest balance sheet and credit non-controlling interest income statement by $5,000. Remember, we follow the opposite for non-controlling interest. If the profit attributable to non-controlling interest has decreased, we will increase profit by crediting non-controlling interest income statement.